Something is breaking between East and West right now, and the fracture is widening with every single session that passes, not in politics, not in diplomacy, in the price of the same metal sitting in two different vaults on two different continents. The Western paper market closed Friday and stamped $84 on an ounce of silver. Clean number, official, done. Meanwhile, 12 time zones away, buyers in Shanghai looked at that same ounce and said something very different. No, the real price is $96. That is a 14.6% gap. And here's the detail nobody is emphasizing. That gap has not corrected once in the last 6 sessions. Not once. Instead, it has climbed steadily, relentlessly, like a pressure gauge on a pipe that everyone keeps insisting is fine, while the needle keeps rising. John O.G. here. And what you're about to hear over the next several minutes connects price data, central bank vaults, futures market structure, and geopolitical pressure points into a single picture that most people are never shown in one place. Because the story forming right now does not exist in one headline or one chart. You either assemble the pieces yourself, or someone who tracks the data does it for you. Let's begin where the money is actually moving, not where the headlines are pointing. That Shanghai premium is not a one-day anomaly. Look at the recent sequence, and it reads like a staircase. 13.5%, 13.8%, 13.7%, 14.5%, 14.0%, now 14.6%. 6 consecutive sessions above 13%, all elevated, all trending higher. When physical buyers in the East are consistently paying double-digit premiums over Western paper pricing, that is not a currency conversion glitch. That is a structural divergence between where paper markets say silver should trade and where actual buyers exchanging real metal say it must trade. And the people making those purchases are not retail investors refreshing apps in the middle of the night. They are institutional buyers, professional desks, entities quietly pulling physical silver out of COMEX vaults session after session. No announcements, no headlines, just consistent withdrawals. Now here is where the picture becomes even more interesting, and where many analysts completely miss what is happening underneath the surface numbers. While institutions are removing physical metal from vaults, the Sprott Physical Silver Trust is trading at roughly a 5.7% discount to net asset value. Pause for a second and let that contradiction settle. Big institutional money is taking delivery of physical metal, but Western retail investors are nowhere near this move. In 2011, that same trust traded at an average premium of more than 17% for the entire year. Investors were paying above the value of the silver inside the trust just for exposure. Today, it trades at a discount. That means if Western retail eventually returns to the market, and history suggests it eventually does when price momentum becomes impossible to ignore, the shift from discount to premium becomes an additional layer of return on top of the underlying metal price itself. Not just silver appreciation, a structural multiplier. And the discount tells us something even more important about this rally. It is not driven by speculative mania in the West. There are no viral Reddit campaigns, no retail frenzy, no social media FOMO wave pushing prices higher, which means the move has not been contaminated by the type of speculative euphoria that usually collapses the moment sentiment turns. This rally is being built quietly underneath the surface. Now let me shift your attention to something that almost no silver channel is discussing, and it may be the most important structural development in this market in decades. For the first time in years, silver is no longer the most heavily concentrated short position in the commodity futures market when measured by days to cover. That title now belongs to platinum. Think about what that means. Silver has carried the most concentrated short exposure for as long as many traders can remember. That era has just changed. The reason becomes obvious when you examine the commitment of traders' data. Over the last 6 months, large commercial traders have been steadily reducing their short exposure in silver futures. Positions ranked 5 through 8, smaller commercial traders, now hold their lowest short exposure on record. On record. These are the institutions that historically provided the most consistent selling pressure in the silver futures market. The mechanism that has capped price discovery for decades, and they are stepping back, reducing exposure, layer by layer. Now the 4 largest traders still hold a significant concentrated short position, and available data suggests much of that exposure sits within 2 major U.S. banks. But when the surrounding architecture of short selling begins to dismantle itself, the structural capacity to control price through paper contracts weakens. Think of the system like a dam. The largest 4 traders are the concrete wall, but the smaller commercial shorts were the reinforcement beams supporting that wall. Those beams are being removed, one by one. The wall still stands, but the engineering supporting it is not what it was 6 months ago. That is not a weekly trading signal. That is a multi-year shift in market structure. And the obvious question is simple. Why now? Why would institutions with the deepest market intelligence, the same ones who held short positions through decades of rallies, suddenly decide this is the moment to reduce exposure? You do not close short positions because you expect price to fall. You close them because you no longer believe the position is safe to hold. That distinction matters more than almost any headline you will see this week. Now let's be clear about something. Paper markets still dominate short-term price discovery. That is mechanical reality. A sudden dollar rally, a geopolitical rumor, or a coordinated algorithmic sell program across futures exchanges can push silver sharply lower in the short term regardless of physical supply constraints. The COMEX leverage ratio still sits near 7 paper ounces for every single registered physical ounce available for delivery, 7 to 1. That leverage gives paper markets the ability to suppress price movements longer than many traders have the patience to endure. And patience is the variable that separates people who capture structural moves from people who get shaken out of them. The gap between paper price and physical reality rarely closes slowly, it closes suddenly, in an event, a dislocation where the paper structure can no longer contain the pressure building beneath it. If you are trading short term, you must respect that volatility. If you are accumulating long term, the frame looks completely different. Because structural deficits do not disappear because of a red candle on a chart. They continue building beneath the surface. Now we need to connect the geopolitical layer because none of these metal flows exist in isolation, and the developments unfolding right now are not background noise. They are the environment shaping everything we just discussed. Recent escalations in the Middle East have moved well beyond rhetoric. Energy infrastructure is being targeted. Shipping routes near critical choke points are under pressure. Naval deployments are expanding. When conflicts approach strategic energy corridors like the Strait of Hormuz, markets begin pricing risk into every barrel of oil moving through the global system. Oil above major psychological levels does not just affect energy traders.